Chapter 3, Part 1. Now what we're going to talk about is all month long we're journalizing, and now we're going to look at what we do at month end. First of all, because of the time period concept, accounting information must be reported at regular intervals. It's a calendar year or a fiscal year, which is any 12-month period. We also have interim reporting, and usually, normally it's every month. People want to know what's going on in the company. They can't wait till the end of the year. So let's kind of walk through that accounting cycle. We always start by analyzing that's financial transactions. We then journalize, we then post, and then we prepare an unadjusted trial balance. That's what we did in chapters 1 and 2. Now we're going to do the next part, which is, and again, this is done all during the month. Then at month end, we're going to do adjustments. And after we do these adjustments, which is what we're going to talk about in this part, we're going to prepare an adjusted trial balance. You can only prepare the financial statements from an adjusted trial balance, and adjusting entries are only done at the end of the month. Now, at the end of the year, we close the books, and then we prepare our final trial balance, which is our post-closing trial balance. This is only done at the end of the year. Only trial balance that can be used to prepare financial review, remember, is an adjusted trial balance. Now, why do we have to do adjusting entries? Well, because we have the revenue and expense recognition principle. Revenue recognition says we have to record it when it's earned, which means the cash is not pertinent. Expense, any costs used to help generate the revenue, are recorded as expenses in the time period of the revenue. Now, we have accrual base compared to cash accounting. In cash accounting, we record revenue when we receive the cash, which is how most people are used to thinking about it, and we record expenses when we spend the money. That's not GAAP. GAAP, we do accrual accounting, which means we have to accrue based on goods and service in the period that they're provided and the expenses when they're consumed. That's what GAAP requires. And because of that, we have to do what we call adjusting entries. At the end of each period, a business prepares financial statements. In accordance with the revenue and expense recognition, we must determine if the accounts reflect all revenue that has been earned and expenses that have been consumed. We do this by making adjusting entries that affect both the balance sheet and the income statement. There are 3 categories. We have deferrals. We talk about those first. These are already on the balance sheet. These would be any prepaids, whether we paid in advance or the client paid in advance. We have depreciation, which is a way we allocate our long-term assets as we consume them. And then we have accruals for any revenues or expenses that are not reflected on the books. Here's the number one thing to remember. Adjusting entries never involve cash. There's no cash involved at all. So we're going to start with our deferrals. We have 2 types. We have prepaid expense. We record as an asset when purchased, and we're going to expense when they're used or expired. We have unearned revenue. This is we receive it in advance, we treat it as a liability, and then as we earn it, it turns into revenue. Let's look at our unadjusted trial balance. One of the things we do is we look to see, do we have any assets we've consumed or revenue we've earned. Based on this trial balance, we have office supplies, which normally you would use during the month, and we have deferred revenue, and we'd want to check to see, have we earned any of it? So now let's assume we earned half of the deferred revenue. So we would debit deferred revenue because it's a liability, so we're going to decrease it, and we're going to increase sales revenue. So now deferred revenue has an adjusted balance of $15,000. That's the amount that's remaining. That's going to be on the balance sheet. And now sales is always going to be on the income statement. Now we're going to look at our supplies. Assume that at the end of the month, we only have $1,000 worth on hand. So our journal entry is going to be to book the expense. Expense is going to go up, and our asset, office supplies, will decrease. So the balance sheet is going to show the $1,000, the amount remaining, and the amount that expired becomes an expense, and it's going to go on the income statement. Now we're going to talk about a new account. We have, and there are two new accounts. We have to allocate the cost of assets that expire or are used up over time, tangible assets, and we have what we call depreciation expense, which is the amount of expense in the period that's consumed, and it goes on the income statement. And we have another account, which is called a contra asset account. It is the sum of all the depreciation expense over the life of the asset. It appears on the balance sheet and again is a contra asset account. It always follows the asset. So now let's take a look at why we do it this way. So what if you bought equipment for $90,000 at the beginning of the year with an expected service life of 3 years? We would allocate this over 3 years at $30,000 per year for depreciation expense. If we did not have a contra account, on the income statement, we would see $30,000 every year, which would be the same regardless of any method. However, on the balance sheet, we would show that we invested $60,000 in the first year. Second year, we'd only show 30, and in the third year, we'd show nothing. Well, we like to know as investors how much people have invested in tangible assets and if they're old and need to be replaced. So that's why we do the contra account. So what's going to happen? The income statement would be the same. However, on the balance sheet, they would see the original investment of $90,000, and then they would see that contra account accumulating the amount that we're expensing each year, and then we would see the net book value. Again, as you can see, they show the same net amount, but with the contra account, it tells the investor how much has been invested in equipment and if it will need to be replaced. Now we're going to look at our unadjusted trial balance to see, do we have any tangible assets that need to be depreciated? Well, we have some equipment. We're going to assume again it's for 3 years, and we're going to book depreciation expense, accumulated depreciation. These go on the balance sheet. You would show equipment, and exactly following it would be the contra account accumulated depreciation. Depreciation expense would show up on the income statement. Again, this is what it would look like on the balance sheet. Now we're going to look at things that are not on the balance sheet at all. And this is what we call accruals. Accruals, we record expense before cash is paid, like the utility bill, you just got it, salary expenses, interest, and income taxes. And we've done the work, but we haven't billed the client, but we earned it. So, our example, we had a notes payable, has interest of 12%, and 6 months have gone by. What amount should be accrued? Well, if you take the face of the note, which is $10,000 based on our trial balance, times 12% equals $1,200. But remember, that's always the annual amount. We only had it for half a year, so we only get to record 6 months. If you notice, this is going to affect both the income statement and the balance sheet. In addition, we provided services on account for $6,000. This is going to be accounts receivable and sales. Balance sheets, accounts receivable, sales. So if you notice, with all of our adjusting entries, they always affect both the income statement and the balance sheet. Now we have our general ledger with our new totals based on our adjusting entries, and we can prepare an adjusted trial balance. We again would list our assets first, Then remember, accumulated depreciation is not a liability. It is part of long-term assets and follows equipment or building. If you have a building, you'll depreciate that also. Then you would show your liabilities, then your equity, then your revenue and expenses. This is the financial statement that you do prepare. This is the trial balance that you do prepare financial statements with. Okay, now in part 2, we're going to prepare the financial statements.